He had a square jaw, silver hair, and the kind of resume that made retirees feel safe. 22 years on Wall Street. Former managing director at a firm whose name nobody could quite verify, but everybody had heard. A track record that beat the index every single quarter for 9 years running. His face was on the landing page, his signature on every email, his voice on every webinar. His name was Marcus Whitfield, and he did not exist. Not the face, not the resume, not the firm, not even the voice. Marcus Whitfield was a single GPU's worth of compute, run nightly out of a one-bedroom apartment in Bucharest by a 26-year-old former ad tech engineer who had figured out something nobody at the SEC had thought hard enough about. You do not need a real analyst to charge people $49 a month to listen to one. You just need the appearance of one. And in 2026, the appearance is cheap. The scam works like this. You stand up a website, you spin up a synthetic person, a face from an AI portrait model, a voice cloned from public domain audio, a backstory fabricated from 100 LinkedIn templates blended together. You give him a credible firm with a domain that looks expensive. You write him a track record. The track record is, of course, retroactive. The trick is to publish a long history of supposed pics dated months or years in the past, alongside their real outcomes, which you already know because you are writing them after the fact. To the visitor, it looks like a man who has been calling stocks correctly for 9 years. In reality, he has been calling stocks since you bought the domain 6 weeks ago. You write daily pics. You blast them out to a list. You charge for the premium tier. Stripe handles the billing. You sit back. The money flows. By the time anyone notices, you have collected enough to buy a second apartment. The newsletter operations run at scale. The biggest ring discovered so far, called Goldfinch Capital Insights by its operators and never anything else by anyone in law enforcement, ran 16 newsletters at once, each with its own synthetic analyst, each in a different niche. Energy stocks, biotech, small cap mining, crypto, dividend income for retirees. Each newsletter had its own face, its own voice, its own resume. None were real. The whole operation ran on 3 engineers in Cluj-Napoca, a Stripe account routed through a Cyprus shell company, and a single subscription to a generative model API. Their billings, before the SEC even started looking, crossed $140,000 a month. They would have crossed $250,000 if the team had hired a 4th engineer to keep the funnels live. What sells subscriptions is the cadence and the credibility. The cadence is easy. A daily email costs nothing to generate. The credibility is harder, and that is where the AI does its real work. Generating the face is trivial now. Generating the voice is trivial now. Generating 5 years of plausible analyst commentary, that lines up with real market events, that is where the model earns its keep. The scammers feed the model the historical price action of the last 5 years and ask it to write what an analyst would have said about each move at the time. The model produces beautifully reasoned explanations. It cites the right earnings calls. It gets the right CEOs in the right months. The output looks indistinguishable from a real archive of analyst notes. Visitors who scroll back 2 years to check the analyst's track record see a complete, coherent, well-written history. They do not realize the history was generated last Tuesday. The subscribers are exactly who you would expect. Most are men over 50. Many are recently retired. They have a brokerage account, some savings, and a strong sense that the market is being run by people smarter than they are, which they want to be on the right side of. The newsletter promises to put them on the right side. $49 a month is nothing compared to the gains the synthetic analyst is implicitly promising. The implicit promise is the key. The newsletters are scrupulously careful never to promise returns. They lean on the past, the fictional past, and let the reader infer. This is also why they are so hard to prosecute. Securities fraud requires a misrepresentation. The newsletters do not technically misrepresent future returns. They just misrepresent who is writing them, what their track record is, and whether they have ever existed. The SEC has an entire enforcement bureau, and even they cannot agree on what statute these operations cleanly violate. A former enforcement attorney named Priya Agarwal, now in private practice, has been tracking the rings for 3 years. She estimates there are at least 300 currently active synthetic analyst newsletters in the US market alone, with another 400 targeting Indian and Southeast Asian retail traders. The combined revenue, by her conservative model, is somewhere north of $120 million a year. The amount actually recovered through enforcement actions last year was $800,000. She describes the gap as obscene. She also describes the technical sophistication of the operators as steadily rising. The early rings in 2023 used clumsy face generators. The synthetic analysts had melted ears, asymmetric earrings, hairlines that shifted between photos. The 2026 rings use models that pass forensic detection 90% of the time. The rings now generate consistent multi-photo identities, the same synthetic person at a desk, on a plane, at a conference, at a charity gala, so that anyone Googling the analyst finds a fully populated digital life. The payments infrastructure is the load-bearing piece. Stripe, Paddle, Lemon Squeezy, and a handful of smaller processors handle almost all of the subscription money. The processors have detection systems for fraud, but the systems are tuned for stolen card abuse, not synthetic merchant abuse. A synthetic merchant looks fine. The card swipes succeed. The chargeback rate is low. Most subscribers are happy because the daily emails feel professional and useful even when the pics are random, and the merchant pays its fees on time. Stripe has, in the last 18 months, taken down somewhere around 40 of these rings after journalist tips and a handful of FBI requests. They estimate they have not caught most of them. Internally, Stripe staff describe a category of merchant called literary fraud, operations that are technically processing real money for real services, where the only fraud is that the service provider is not who they claim to be. Literary fraud is not yet illegal in most jurisdictions, it is just unpunished. The content itself is sometimes genuinely good. This is the part most readers find hardest to accept after the takedowns. A young woman in Phoenix who had subscribed to one of the larger fake newsletters for 2 years, paying around $1,000 total, told a reporter she did not regret it. The picks had been roughly 50-50, which is what the market is. The commentary had taught her how to read a balance sheet, how to think about earnings, how to size positions. She said she had genuinely become a better investor because of an analyst who had never lived. The reporter asked her if she felt deceived. She said she felt cheated of the relationship more than the money. There was a man she pictured every morning when the email came. He had a name and a face and a coffee mug she could see in the corner of his webcam. Now there was nobody in the chair. The chair, it turned out, had always been empty. The legal response is uneven and slow. The SEC's first synthetic analyst case, in late 2024, was won on a narrow theory of impersonation. The operators had borrowed the resume of a real retired analyst without his knowledge, and the real analyst sued. That case set no broad precedent. Subsequent cases have struggled. Prosecutors have to prove that the misrepresentation was material to investment decisions. Defense lawyers argue, with some success, that subscribers were paying for the content, not the identity, and that the content was substantively similar to what a real analyst would produce. Judges have been split. Until Congress writes a synthetic identity statute that names this exact pattern, the rings will keep running because the math of running them is irresistible. A team of 3 engineers can clear $1 million a year, after expenses, with almost no enforcement risk and no need to ever hide a real person's identity. The longer-term concern, voiced by people inside Stripe and inside the SEC, is that the synthetic analyst pattern is a template that ports easily to neighboring categories. Synthetic doctors selling supplement subscriptions. Synthetic lawyers selling will templates. Synthetic therapists selling Tier 3 coaching plans. Synthetic professors selling exam prep. Each one takes the credibility of a profession and synthesizes it. Each one charges a recurring fee. Each one collects through legitimate processors. Each one survives because takedowns require manual investigation that no agency has the manpower to staff. The first wave was investment newsletters, because investment newsletters are where the willingness to pay is highest. The next waves are already starting. The first synthetic doctor supplement subscription was identified in March of 2026, with 17,000 active subscribers paying $89 a month. The doctor in question had a face, a voice, a residency at a hospital that does not run a residency program, and a Stripe account doing about $1.5 million a month. By the time it was reported, the operators had migrated to 2 new identities and were already running supplements for joint pain and sleep. The takeaway for anyone watching this from the outside is uncomfortable. The cheap test you used to run, does this person have a real face, a real voice, a real history, does not work anymore. None of those signals are reliable. The expensive test, does this person have verifiable, primary source, cross-referenceable existence outside their own websites, is the only one that holds. Almost nobody runs the expensive test, which is why these operations work, which is why they are growing, and which is why somewhere right now, on a clean website with a confident analyst and a polished track record, somebody is reading the morning email and clicking the link to upgrade to premium. The analyst has never lived, the card will charge, the market does not care, and by tomorrow morning the daily pick will hit their inbox again, signed off in the warm voice of a man who never existed.